I think the most underrated, highest impact development in today's ETF landscape is the direct impact on investors' bottom lines, be that measured in fee savings relative to what they might pay to access markets via other managed investment products, or be that in the form of the tax savings that accrue to them just due to the nature of the ETF wrapper and its superior tax efficiency vis-a-vis other means of consuming investment strategies, be they active, be they passive, be they somewhere in between. Now, this is not new news. This has been known for decades. This is what has attracted trillions of dollars worldwide to ETFs, but I think it often goes underappreciated and sometimes maybe even unnoticed, because what tends to dominate the headlines is all of the fanfare around whether or not there might be a Bitcoin ETF approved in the US, or what is the latest high-flying thematic fund. Meanwhile, most of investors' hard-earned dollars are continuing to flow into the lowest cost, most tax-efficient, most heavily traded ETFs that offer broad-based, diversified exposure to large segments of the market. And those don't tend to capture headlines because they're very boring, which is exactly the way that most investors should approach long-term investing. I think it's been quite some time since innovation in the ETF space crossed the divide between innovation and what I would call proliferation. And what we see today is really proliferation. So while there are a multitude of new products that are coming to market, very few of them are what I would deem to be truly innovative, offering something new, something differentiated, something useful to investors that didn't already exist on the ETF menu. So as we see more and more ETF proliferation and less true innovation, it behooves investors to be more cautious than ever when it comes to making selection decisions from this now expansive ETF menu. I think both ESG and thematics are categories of ETFs that have long-term durability. They're going to be around with us for quite some time. Now, that said, the specific players, the specific funds in each vein are going to come and go in some cases. They're going to evolve in other cases. So what we've seen in the case of thematic funds, which have been around now for decades, is that thematic fund development tends to be a bull market phenomenon. It's at a point in time when markets are roaring, when animal spirits are percolating, that we see more and more sort of spaghetti getting thrown at the wall, more new ideas coming to market in a managed investment product, be it a mutual fund around the era of the dot-com bubble, be it today in the ETF space, where we've got everything from cannabis funds to artificial intelligence funds to now even funds based on psychedelic drugs. The characters in the thematic space are going to churn. What we've seen is that the long-term survival rate among thematic funds is quite low. Many of these funds are based on themes that aren't durable. They invest in stocks that might not necessarily have direct exposure to whatever the theme is that they're going after. And they tend to be launched at a point in time where investors' enthusiasm around these themes has priced shares so high, driven valuations up to levels where future returns are in all likelihood going to be disappointing. And that's exactly what we've seen pan out in the long history of thematic funds. Now, ESG is an entirely different category. What I would say is that ESG is really only going to continue to evolve. It's a very dynamic area. It's an area of growing importance to a growing number of investors. Today's ESG is the latest iteration of what has been a long-standing attempt for investors to marry doing well with doing good. And I think we're going to continue to see ongoing innovation, ongoing evolution within that particular product set for a long time to come. Well, I think what's ultimately going to bring this period of high valuations, rampant flows into ETFs and into just markets more generally is the same thing that got us here to begin with, which is animal spirits. It's investor behavior. It's the fact that there have been few viable alternatives other than investing in the market, investing in equities, and investing in brand new things that are the end product of our collective imagination. From Bitcoin to Dogecoin, to virtual, NBA NFTs, you name it. This is evidence that the animal spirits are alive and well in markets. What causes those animal spirits to sour, for markets to stop percolating, for valuations to compress is anybody's guess, but ultimately at some point the punch runs out in the punch bowl, the music stops, the party ends, and valuations will come back down to earth.